Hello class, welcome to the chapter 2 handout 2 answer video. Okay, for this video, you're probably going to need to, hopefully you've looked at it, try to do it on the sheets that I provided for you in your modules there. We're going to make some journal entries, we're going to post them into T accounts, and then it is making a trial balance. Okay. Hopefully you try to get stuff into these journals, wrote them in, or use the Word version and type them in. And you use this to check your answers. Okay, we're gonna have one more video after this and handout 3, where we'll go over some more journal entries because, as I mentioned in the lecture video, this is probably the most important thing you're gonna need to get down is how to make these journal entries. All right, so let's start here. Handout 2, well, I better share my screen before we get going too far. All right, so we have our general journal here. We're going to make some journal entries for Gale Incorporated into the following transactions during January. Okay, so A, on January 1st, so the first thing we do is we put our date in there, January 1st on 1/1. Gale borrowed $50,000 from First Street Bank by signing a note payable. So we're analyzing it here, the amount we have is $50,000. And we borrowed money, meaning we are going to receive cash, and we signed a note payable. So our two accounts are going to be cash and notes payable. Cash being an asset is going to be increased with a debit entry. So we always enter our debits first. We're going to enter cash as our debit entry in the amount of $50,000. And here, the note payable is our other account. A note payable is a liability. We owe more money now. That liability has increased because we owe more. Using dealer, we remember that liabilities have a normal credit balance. So to increase it, we need to make a credit entry. B, on January 4th, we purchased $25,000 of equipment for cash. Analyzing it here, our amount is $25,000. What are our two accounts? Well, we have equipment, which we received. It's an asset. It's going up. Okay. And then we paid cash, which is an asset. And now it is going down because it is going out of the company. So to enter this one on, we put our date 1/4. Equipment and asset gets increased with a debit entry. And an asset going down gets decreased with a credit entry, and the amount was $25,000. On to C, we have what happened on January 6th. We paid $500 to our landlord for rent in January. Well, rent is a normal business expense, so that will be an expense account, rent expense. And we pay $500, so we have cash going away from the business. Expenses are the first E&D dealer, have a normal debit balance. So we enter our debit first, rent expense for $500, and we paid it in cash, an asset which is decreasing. So if we decrease an asset, we need to make a credit entry for $500. And there we go with that. I hate when I hear those little sounds on my computer telling me that my camera and my speakers are jacked up. All right, our next entry, 1/15, January 15th. Perform services for customers on account for $10,000. So anytime we perform services or deliver goods, that is revenue. Okay, our amount is $10,000. Revenue has a normal credit balance, so we're increasing that with a credit, but it tells us it's on account. So that means we do not receive any cash. Instead, we send them a bill. They owe us money now. They're going to pay us later. When somebody owes us, that is an accounts receivable. Accounts receivable is an asset. They owe us more, so we can increase our asset with a debit entry, and we increase our revenue. In this case, we provided a service, so it's service revenue in the amount of $10,000. On 125, we collected $3,000 from customers that we did just in the one right above us. Okay, so now we are going to receive cash because we collected the cash, but now they no longer owe us. So our receivable can go down because people no longer owe us that much anymore. So to increase the asset of cash, we make a debit entry for $3,000. And at this point, we can decrease our accounts receivable because they no longer owe us by the same amount. And to make that asset account go down, we make a credit entry for $3,000. On 128, we purchased land for $200,000 by paying $10,000 cash and obtaining a loan for the balance. Well, here is our first example that we're working on where we are going to have 3 accounts that are affected here. Okay, we purchased land. Land is an asset. We are increasing our assets, so we're going to go ahead and put that on first. Land for $200,000. And then it tells us we paid $10,000 cash. Cash is an asset that is going down now because we are paying it out. So to decrease our asset of cash, we make a credit entry for $10,000. And see, we can't stop there because our credits and our debits, they must equal each other. Always, always, always. That's in order to keep that accounting equation intact. It tells us we obtain a loan for the rest of the balance. So if we got a loan from the bank, we signed a note. Okay, we did a formal agreement to get that loan. It is something we owe in the future. It becomes a liability. We will call it a note payable. And since it increased, the liabilities have a normal credit balance. We want to make a credit entry for the remainder of $190,000. And now you can see when we put those together, now our credits do equal our debits and our accounting equation has stayed intact. Finally, for G, on January 30th, we paid salaries of $2,500 for the current month. Salaries, a normal course of business. Whenever they get earned and we go to pay them or the period ends, that is an expense. Okay, expenses are the first E and dealer, normal debit balance. The expenses are going up, so we will make that. And it says they were paid. Since they are paid and not owed, that means cash is going out. So to decrease our cash, we do a credit entry for the $2,500. So there are the journal entries for number 1. The second part of this problem, then post them into T accounts. Okay. This on down, here are our T accounts. Okay, so I'm going to do, so first we have cash for $50,000 and a note payable, transaction 1. So I need to create my T account here. So I'm just going to make this one is going to be my cash. And it doesn't really matter which one you used. Okay, but once you use it, you label it on there. What did we have in number 1? We had a debit to cash and a credit to note payable. Okay, so the cash is going to be entered on the left side, while the note payable is going to be entered on the right side. So I'm going to put 50,000 over here and 50,000 over here. And just out to the side, I'm going to put a little 1 which denotes that that was transaction one. Now, if you ever have to do a whole bunch of these, you see this is what this little PR is for now. Okay, you don't have to do this, but I'm just going to mark it right there. Okay, let me know that I have now posted that. Okay, post reference. Ideally, what's going to happen there in real life is you're going to enter the account number. Each one of your accounts is going to have a specific number assigned to it. Like cash might be 101, or your note payable might be 204. Okay, so then that number would go in there. But while for practicality in this class, that's what that PR can be used for. So that way you know you have moved that journal entry, you have posted it into your general ledger or into your T accounts. Remember that term, posting, that's what that means. So on 1-4, we had equipment and cash, with equipment being debited and cash being credited. Come down here. I don't have an equipment account yet, so I need to create my equipment account. And it increased by 25,000. Our cash this time was credited, so we put it on the right side. I'm going to note that with a 2. Our third event, we paid $500 to landlord for January rent. Okay, now we have another new account we need to make. We need to make a rent expense account. We did not have one of those before. And if you look at your journal, you'll notice that we debited that rent expense in transaction 3, and we credited cash. And number 4, our fourth entry on January 15th, we report services for customers on account for $10,000. Our entries here, we have an accounts receivable. And we had service revenue. Okay, our service revenue in this example was credited by 10,000, and our accounts receivable was debited by 10,000. In E, we collected $3,000 for customers for services performed in transaction D. All right, so if we look at our journal entry, we collected $3,000 in cash, or our cash increased. So we made a debit to cash. And we did a credit to accounts receivable. And F, or number 6 here, January 28th, we purchased land for $200,000, paying cash and obtaining a loan for the rest. So again, we have another new account that we need to create. We have our land account, which in this case we debited for $200,000. We also credited cash in that amount because cash went out when we did that. And the rest of it we put into a note payable, which is a liability with a normal credit balance. Okay. So we're just taking the journal entries, basically moving them down, posting these into these accounts. And finally, on January 30th, we paid salaries for $2,500 for the current month. Then we've got to make another account because we do not have a salaries expense account yet. And we debited that for $2,500 here in number 7. And we credited our cash because cash was paid. Okay. As you can see, some of them with only one entry, it's really easy to figure out the balance. And now we can go through and we can figure out our balance in the cash account. Hence, I know that cash is an asset that has a normal debit balance. It is going to have a debit balance at the end. So what I can do is add up my debits. The 50,000 plus the 3,000 gives me 53,000. And then I can subtract all of my credits off of that. So 25 minus 25,000 minus 500 minus 10,000 and minus 2,500. And I am shown that we have a $15,000 debit balance like the way that was written. We have a $15,000 debit balance in my cash account. But, so since I have them all posted there, it's really easy. Now imagine if you want to know how much cash you had. See up here, you kind of have to go through and you have to look at each one and kind of take them as they come. Okay, so especially can be seen on accounts that are less active than cash, like our accounts receivable. Once we have it posted, we can tell here how much do we still need to receive. Well, we have a $7,000 balance here, so we are still owed $7,000. So if we were going to make a financial statement, we would have an asset of $7,000 in accounts receivable that we still need to collect at some point in the future. The only other one that we need to get a balance on is over here. Our note payable balance becomes $240,000. That would be the amount that would go on to our balance sheet. And therefore, our investors would know that we owe money in the form of notes for $240,000. And from here now, if we needed to make a trial balance, we could go through and plug those all in, but the question does not ask for it. It gives us some new information over here to make a trial balance with. But you make your trial balance from your T accounts here. That's how you would post them, make journal entries, and then the process is called posting them into the ledger or the T accounts. All right, so number 2 here, listed below are the ledger accounts for Fortress Inc. on December 31st. All accounts have normal balances. It asks us to make a trial balance. Okay, so we're going to write out all our active accounts. All these accounts are active because they have a balance in them. We need to make sure we do them in order. We go cash, liabilities, equity, revenues, then expenses. I say cash, I meant assets. Assets, liabilities, equity, dividends, revenues, expenses in that order. So we'll start looking here. First, we have cash as our first asset listed here, and it is a debit balance of $12,850. This is an asset, has a normal balance of a debit. I go down my list, I don't see any other assets on the right side or on the left side. When I get to the right side, I see that we have equipment and accounts receivable. So I'm going to keep them in the order that they will be made on the balance sheet. Remember, current assets get listed first. So I'm going to keep my current assets together here. We have accounts receivable in the amount of $5,700. Excuse me. And then our final asset, we have equipment. The equipment was $12,725. So now we have all of our assets put into our trial balance. Okay, I'm going to go ahead and just mark them off on my sheet as I go, so I know they've been used and I don't need to double them up. Next, we come to liabilities. So on the left side, when I look down, our first liability is accounts payable. Put it up, it is at $2,825. Liabilities have a normal credit balance, so make sure we put it on the credit side of our trial balance. Common stock, rent expense, no. Dividend, salary, advertising. That is it for our liabilities. Nothing else on our sheet here is a liability. Now we move on to equity. We can have contributed equity, which is most common for the corporations is common stock. Okay, or we can have retained earnings. I only see common stock on here, so we'll list common stock next. And the amount was $15,000. Equity is the second E in dealer. Normal credit balance, so we put it on the credit side. After our equity then, Then we have dividends. We do have dividends declared of $1,500. Dividends, and dividends is the first D, is the D end dealer. I guess the only D, I shouldn't say first. It is the D end dealer, has a normal debit balance. So we need to make sure we put it on the debit side. After that, that is it for dividends. Next, we go to our revenues. First and only revenue we have is called service revenue. Revenues is the RN dealer, a normal credit balance. So we need to make sure we put it on the credit side, 23,150. That is it for that. And then all we have left now are rent expense, salaries expense, and advertising expense. Expenses are the last thing we record. So we'll go ahead and write these up here. Rent expense, salaries expense, and advertising expense. Expenses are the first EM dealer, come as a normal debit balance. So we need to make sure we put these on the debit side. We have 2,400, 4,300, and 1,500. Now that we have everything onto our trial balance, the last thing we want to do is we want to add everything together to make sure that we actually do balance and we do not make a mistake anywhere, putting something on the wrong side or transposing any numbers. Added them all up, I got 40,975 as my total debits. I look at my credits. And I get 40,975. My debits and my credits balance. This is a good trial balance. It's unadjusted. Okay. In chapter 3, we're going to talk about how we make adjustments to this. And in this trial balance now, we can go, if we wanted to, we can make our statements. So we can make our income statement because we have our revenues and expenses. They would turn into retained earnings, which we would add on to an adjusted trial balance. And then we could make from there, we have everything right in one place in order to make our balance sheet. So those are the answers for handout 2. Hopefully that helped you out a little bit. We've got one more practice handout on journal entries in handout 3. And that should get you to be able to get through your homework if you've been watching everything and reading along in the book. Talk to you again soon.